All right. Good afternoon, everybody. It is 12:30 today, EST. I was on a call with a pretty cool guy that we're helping on the conference side. So welcome to the Real Estate Show. We go live every single Monday covering all things real estate investing. And I have to give a shout out to the team. We are Tough Mudder champions. Well, I should say Tough Mudder participants. But on the weekend, the team is out rocking and rolling. Mostly rolling through the mud. So Robbie was there with his broken fingers and his camera, and he was capturing everything. So we'll post some fun stuff. If you want to see Katie rolling around in the mud, tune in to our Instagram for that. But today, real estate. What are we talking about? We are talking about how to analyze a real estate deal. What goes in to evaluating a deal to make sure that you're making a good decision rather than getting yourself in the deal that goes wrong. And then you have all sorts of issues that come along with that. Okay. So what we're going to do is we're going to focus on three distinct periods of time in terms of how we look at a real estate deal. As when we're evaluating deals, we really have to be let's call it Sherlock Holmes today. But then we have to have a crystal ball that tells us what the future is going to behold, even though nobody has a working crystal ball. So what we're going to do is I call this the 3 T's of underwriting. Now, underwriting is a fancy term for analyzing or evaluating a deal. So if you ever hear somebody say with real estate, oh, I'm underwriting this deal, or, oh, what can you check your underwriting, or I have to check my underwriting. They're talking about how they map out the future business plan of the deal and all the assumptions they're making, which is very different from underwriting a mortgage, which is where they do the same thing, but they're analyzing risk in terms of borrowing. But when we're talking about real estate investing and somebody says, hey, I want to underwrite this deal, they're basically saying, hey, I want to analyze, evaluate this deal to see if it fits. So that's what we're going to cover today, the evaluation, the analysis of a property. So the 3 T's of underwriting. So the first T right here is it's going to be today. Now, what do we have to focus on with the property today? Well, we're really looking for, hey, what exactly is this property doing at this period of time that we know to be true? So we don't worry about what it could do, the future potential. We're focusing on what is going on today. So a couple things you have to get when you're doing this phase. Number one, you have to get what's called a T12. So a T12 is really the past 12 months of financial statements for the asset. So that's going to include things like rent, all the different revenue streams, all the expenses, all the repairs, all the maintenance, all the staff salary costs that go into running the property. Now, depending on the level of sophistication, if you're buying 100, 200, 300, 500 units at a time in one property, you're going to get these really nicely detailed Excel spreadsheets. Everything's organized. The property management software will spit out all of these numbers, and it's really packaged nicely. Now, on the flip side, if you're dealing with more of a mom and pop seller, somebody who just owns it because it's been in the family, somebody who's a little bit more unsophisticated, so they're not treating it as a business, you're not going to get those nicely detailed Excel spreadsheets. You're likely going to find that you're missing some information. You're going to get back of the napkin types of reporting. Maybe you won't even have leases signed. There's going to be a huge disparity between the lower tier, the unsophisticated owner versus the high sophistication level at a more commercial scale. So you could get whatever it is. But at the very least, you want to get the T12. If you don't have the T12, you want to get as much as you can. You want to know, hey, what are the rents today? So here, let me write this out. You want to get the rent roll. So the rent roll is going to tell you who occupies what unit, when the lease commenced, so when they moved in, how much they pay a month. Because why do you need to know this stuff? Well, number one, you want to know who's occupying the unit. Number two, you want to know when they moved in. Because what happens sometimes is as soon as somebody decides they want to sell, they want to pump as many bodies into that property as possible because it's going to make it look a lot more full. And when it's fuller, there's going to be more people paying rent, and that's going to increase the NOI, which is going to increase the value of the asset. So, but it's important to recognize, because let's say, 2 months before the property went up for sale, a whole bunch of people moved in. You have to question, are these actually quality tenants? Because it looks like they just pumped, 13 to 15 new tenants in that month, and the average is 3. So are they just trying to stash as many people in that property as possible just to make it look full? Am I going to have issues down the road with these people because they just took anybody with a pulse? You need to know that type of stuff. But yeah, you have to know who's in your unit. Then you're going to look for leases. So what are the signed contracts? What do they say? What's included? Because oftentimes you'll find a discrepancy, especially if you're dealing with more unsophisticated people. They tell you, oh, so-and-so is paying this amount, but then you look at the lease, it's different, or there's different things included. Maybe they've included free cable for 12 months, even though that wasn't advertised. You need to figure this stuff out, because really what you're looking for in the today phase is what is actually going on at the property at this very moment in time. So if you don't have a handle on what's coming in, what's going out in terms of revenue, you don't really have a handle. So you have to know exactly, hey, how much revenue is being produced in this asset, how much income is being produced in terms of rents, and then what's going out the door for expenses. So what's going out the door for salary, maintenance and repairs, all the typical stuff, utilities. And then you might have a good handle on your operating expenses, so your OPEX. So operating expenses, that's going to be, hey, what are the utilities? What do you pay for the pest control guy? What do you pay for landscaping every single month? What software are you using at the office or to manage the property? And then you also want to find out what your revenue is. So your revenue is going to be divided between your rent, and then you have other income. So that could be laundry, that could be pet fees, application fees, late fees. Maybe you have an upcharge for certain amenities like parking, premium parking, trash pickup. You want to know what's coming in, because if you have a handle on, hey, what exactly is being brought in and then what's going out, now you know how much money's left over that can go back into the property, that can be turned into distributions, improvements with the asset. Okay, so that's what you're looking for today with the T12 and all the supporting documentation here. Because if you don't understand what's going on with the property today, you have no clue. You can't even start building a business plan for tomorrow. So once you've figured out today, now we figure out what's going on tomorrow. Where are you going to take the property once you get control of it? So this is where we start making some assumptions about what you can do. Because if you're a value-add investor, and really value-add investing is where you take an asset that's performing under market standard and you bring it up to standard. Maybe it's under rented. So the average market rents in the area are $1,500 a month per unit, and maybe this property is operating at $1,300. Everything else is the same. Well, now you can take this property and bring it up, raise the rents, and now you bring it up to market standard. Or maybe it's 90s vintage. You still have the 90s paper borders around the kitchen. Kitchens look dated. Well, all the rest of the market's operating up here. They've been updated. This asset's still underperforming in the market. You acquire it, you do the renovations, you fix it up, you make it look nice, and now you're going to bring it up to market standard and raise the rents at the same time. That's what we're doing in terms of the value-add business plan. So now what we have to do is we have to make some assumptions. We have to guesstimate with as much real details as possible what the property may do in the future. And this is where some new people get in trouble, because they just say, oh, well, I'm going to do this and this and this, and this is going to be the result, without finding proof in the marketplace. So the very first thing we have to do is we're going to find proof. Proof or it didn't happen. What I mean by that is, let's say we're acquiring a property, and it doesn't matter what it is. It could be a huge apartment building. It could be a duplex. It doesn't matter. What we want to find is an apples to apples comparison of a very similar property achieving the results we're looking for. So let's say, we're always talking about multifamily. So let's use a multifamily example. Let's say I'm buying an apartment building, and the building I'm looking at is primarily 2 bedrooms, 1 bath units. Perfect. And it's 90s vintage and it's under market rents. So I'm going to look for other properties that are 90s vintage, 2-bedroom, 1-bath, that have been renovated. So maybe they replace countertops, maybe they replace kitchen cupboard doors, maybe they replace vanities, painting and flooring. Maybe that's what they did, and maybe they busted down a wall to open things up. So I'm going to look for other assets just like that in the marketplace, and then I'm going to look at my asset. Okay, well, if I do the same things that these other properties did, they achieved, let's call it a $250 rent premium. So now I can say, okay, well, I have proof now that if I do X, Y, and Z in this market with this type of asset, this vintage, this size, this style, then most likely I can achieve the same results because it's proven it's being proven multiple times. I want to look for proof in the marketplace that other people have done it successfully, and that's what I'm going to base my numbers off of. Right. So if I'm looking at an asset and say, oh, well, this is under rented right now, it's $1,250 a unit, and the market standard is $1,500. I want to look for other apples to apples comparisons in the same marketplace that are exactly the same or as close as possible to the asset I want. Perfect. Because now I can support that and say, okay, well, this is my business plan, and because of these 3 examples in the same neighborhood doing the exact same business plan, they've achieved this. Well, it's, if they're currently achieving those numbers, well, I can safely assume that I can come somewhere close to that, right? As long as it's a true apples to apples comparison. What people do instead is say, hey, I'm not going to look for proof, or hey, nobody's done this before, but I'm amazing, and I'm going to go ahead and make this happen, and there's no proof. So what happens when you assume? Well, you make an asset of you and me. It happens all the time. And especially if we're raising capital from other investors, if we're partnering with people, we have to make sure that we're not guessing, because guessing is too risky. We have to use proof. So think of it this way. If you're approaching investors, if you're raising capital for your deal, and the investor is asking you about your business plan and they're challenging you on it, and they're asking you, hey, well, how do you support these numbers? These look a little fishy. And you say, oh, well, this is what we're doing. This is what we're going to achieve. It's not going to go very well. But if you say, hey, Mr. Investor, I'm glad you asked that. We've actually done our research and look at these 4 or 5 properties that did the exact same business plan, and now they're achieving these results. So because of this, we are taking a conservative approach and assuming that we're going to do the lowest performing numbers out of these examples rather than the highest performing for our projections. Right. So, hey, if we hit our bare minimums, this is what we're going to do. But if we actually do average or above average, just like these 2 asset examples here, well, this is what we might be able to accomplish. That's how you do it. Because now you can point to specific properties, specific assets, specific proof. And that's going to make your business plan so much better with investors, with potential partners, and with lenders, with the bank, because the banks want to see this stuff too. Okay. So that's proof. So what kind of things do we have to forecast, right? Because that's really what we're doing. We're forecasting future performance. Well, we have to forecast potential future rent. So where are we planning on taking the rent from today to tomorrow? So after 12, 18, 24 months, where are we going to have the rent once we implement the business plan? We're also going to forecast renos. So some people call it CapEx. That's your capital expenditure. So your CapEx, your reno budget. So what do we have to put into this property? How much money do we have to invest in terms of renovations to allow us then to have an asset where we can increase the value or increase the rents, and that's going to increase the value of the asset. So what types of renos do we have to do? And what's the timeline for completion? Is it going to be a 2-year business plan that we're implementing? Is it a 12-month thing where we're just doing lipsticks? We have to figure this out. And also, this is where you look at your examples and your proof. What renovations, what work is going to get me the best bang for my buck? So if all these other assets are adding dog parks and they're achieving a huge rent premium because everybody has their fuzzy pets, well, guess what? You're probably going to do a dog park. But if 2 of those assets added a business center, but you don't see any movement in rent and the assets with business centers and without business centers, they're both achieving the same market rents. Well, but they all have dog parks. Well, guess what? You're putting in dog parks. You're not going to do the business center because it hasn't done anything in terms of the rent, right? So chances are that's an amenity that the market's not really looking for, but everybody's going to want the dog park or the barbecue pits, whatever it is, or the gym, right? So you have to look at, hey, what renos, what work are you going to do that's going to get you the best bang for your buck? So we're forecasting rents, we're forecasting renos, but then we have to forecast expenses. So with the expenses, we have to look at staffing management charges. Is there going to be a difference between the way you manage the property and the old owner? Are you going to decrease staff? Are you going to add staff? Are you going to bring a third-party manager? These are all decisions you have to make. And then what's your advertising campaign like? Are you going to do things differently? Are you going to keep things the same? Insurance costs. Is your insurance going to go up? Is it going to go down? Maybe you have a blanket policy that you can apply from your other units. You have to ask these questions because maybe this current owner they're very inefficient in terms of operations. So they have somebody renting out the units. They're not very good. So they're bleeding a lot of opportunity because they just don't have the right staff in place. So maybe your business plan is, hey, we're going to go and acquire this asset and put in a new person, one of our people who we know can close new contracts for tenants. Perfect. So maybe you take your closing rate from 5% to 15%. Perfect, right? And then you can work on getting it up to 20%, 25% later on down the road. But that would be part of your business plan. And you're going to assume this. So in 2 years' time, once the asset has stabilized, right? That's a key word. That's a fancy word, stabilization. Once you've stabilized the asset, once you put things the way you want them to be, how's the property going to operate? So where are your expenses at? Where's your staff, your management, like all of that? Now you're operating at where you can operate it. Okay, so that's tomorrow. The third thing we have to figure out is, here's the fancy word, terminus. I used to call it exit, but then I was 2 T's and an E. So now we have the 3 T's of underwriting. So it's today, tomorrow, and terminus. Basically, this means what happens when you sell. So here we have to make a couple assumptions. How is the market going to be when we sell this property? Now, some people like to assume the market's going to be better than when they bought it. That's a very risky way to do things because in real estate, there are so many things that can shift that you have no control over. You can control what price you buy the asset at. You can control how you manage it. You can control the renovations, how fast you reno, what exactly you do, what rents you charge. You can control all of that stuff. You can't control interest rates. You can't control global illnesses. You can't control war. You can't control natural events. You can't control government policy, right? You can't control those things. So if you're assuming the market is going to be better when you sell, that's risky business, right? Because there's so much that you can't control. So what you want to do is you want to assume the market is going to be worse than when you acquired your property. So let's say you bought it and your property's you bought the property and it's 95% occupied. Well, you want to go back in the history books and look at the history of that property and similar assets in that marketplace and find out how those assets performed during the worst recessions. 10 years ago, during the dot-com bubble burst, during 2008, 2009, the global financial crisis. How did it perform? Like all the economic downturns. What happened? Did occupancy drop down to 85%? Well, if so, you're going to want to start underwriting at 85% to make sure your deal is still sustainable in case it happens again. Because, if with real estate, it's very cyclical. What happened in the past, it most likely will happen at some point in the future. So plan for it. The future is not always rosy. In fact, sometimes it's downright unpleasant. So plan for it. And your investors will thank you. Because if you can show the investor, hey, Mr. or Mrs. Investor, these are our projected numbers, but just so you know, we've actually looked at worst case scenarios. And in the worst case scenario, if this and this and this happens, these are the expected returns. But I want you to know that we've planned ahead for this and we've got contingencies in place and this is our plan if this happens. Your investor will thank you for thinking ahead rather than just avoiding talking about risk altogether. So you have to do this homework up front. So you want to assume the market's going to be worse, lower, and what does that look like? Well, if you're acquiring commercial property, you're going to want to assume the cap rate is higher than when you acquired it, right? Because cap rates are an inversion of a multiple. So what that means is the higher the cap rate, the less money per dollar of NOI produced that the asset's going to give, or that investor is willing to pay. Now, the lower the cap rate, it's called compressing cap rates. If you lower the cap rate, that means that investor is willing to pay more for each dollar of NOI produced. We've got other videos of that that you can check out. We'll do another one soon, talking about NOI and how we figure that stuff out with cap rates. But all you have to think of is, hey, is the market worse? Higher cap rates or less money per unit is being charged. So maybe everybody's paying $250,000 per unit right now. Well, you might want to assume that somebody's going to pay $220,000 a unit or $200,000 a unit. And what happens to the deal and your numbers if that happens? Stress test it. What happens if your revenue drops, your rents drop magically right before you sell? What happens if you're planning on doing a refinance in year 2 or 3 and that doesn't happen? How is that impacted? What happens if you have to go out and get another mortgage on the property because something really bad happens, but your rents have dropped? Can you still qualify for that amount of the loan? You have to ask these questions. Okay, so that's the exit. And then we're also planning on commissions. So your broker commissions, is there a fee, a penalty for breaking the mortgage? You want to itemize all of that type of stuff. As what you're left with is, okay, well, this is how the property is operating today, real numbers based on what's actually happening. Then you're saying, okay, well, if I acquire this property today, this is what it's going to look like tomorrow once I implement my business plan. And this is exactly what I'm going to do. This is how much this is going to cost me. These are the results that I'm probably going to get based on these examples, apples to apples. I have the proof. And then, hey, when I decide to sell this property right here, I'm forecasting a worse market. It's going to be horrible market conditions. I have all these fees that I have to pay. I know the commissions I have to pay. And at the end of all of this stuff, this is what I'm going to get out of the deal. This is what the investors are going to get out of the deal. And this is what we're going to do if something goes really, really bad. That's underwriting. That's deal analysis. That's understanding your deal at a very high level. Now, 99% of investors, when they're starting out, don't do any of this stuff. And it's dangerous, right? You have to understand what you're going to do with the asset once you acquire it, what the asset's doing currently in real life, and then also what's going to happen when you sell. As too many people, they'll take the broker listing package. It looks all nice. It's got all these fancy projections in it, but it's all fairy dust, right? The only person you can trust in terms of underwriting is you and your team. So if you're relying on the selling broker's numbers, well, that's based on nothing. That's based on trying to sell the property, right? So obviously they're going to paint the property and make these great projections. They don't have to make it happen in real life. You do. So you have to be so sure that you can actually make that happen yourself. And that's why we do the 3 T's of underwriting: today, tomorrow, and the terminus. All right. So I hope that's helpful, but that's our approach when we're analyzing properties. So if you're interested in learning more about how you can get into multifamily investing, maybe you're doing single family homes, maybe you're investing in something else and you want to get into your first apartment building deal, go to theapartmentaccelerator.com. Check it out. Yep, that's the right one. Theapartmentaccelerator.com. That's our program where we actually help other investors get into their first multifamily property. We'll coach you along the way. We'll hold your hand. We'll give you our tools and systems. So it's parachuted in and you just follow along the process. All right. So I hope this was helpful. Underwriting, very important. One of the most important things ever in real estate. And if you follow this, you'll see some success. So I'll see you tomorrow, 12 o'clock Eastern for The Bullpen, my favorite show. I'll see you then.